When I first started investing, I was completely lost. I had my Wealth Simple account open, I was staring at all these stock tickers, Shopify, RBC, Amazon, and I had no idea which ones were actually good businesses and which ones were just noise. Warren Buffett this, Warren Buffett that. Sound familiar? Of course it does. Here's what I discovered. His entire strategy, it's not complicated math. It's an 8-point checklist. And today, I'm going to walk you through every single rule so you can pull up any stock, run it through this filter, and know within 5 minutes if it's worth your money. Let's be real. Investing feels complicated because everyone wants it to feel complicated. The geniuses on YouTube show you 20 indicators on a chart and tell you they found the next big thing. But the greatest investor in history, the guy who turned $10,000 into billions, he doesn't use any of that. Buffett built his fortune on common sense, simple rules, and I'm going to give you every single one. So rule number 1, look for consistent revenue growth. Revenue, that's just the total money coming in before any expenses. Simple. Pull up any company and look at the last 5 to 10 years. You want to see the numbers going up. If revenues are all over the place, up one year, crashing the next, that's a big red flag. It means the business is unstable. Maybe their market is shrinking. Maybe competitors are eating their lunch. Either way, not a Buffett stock. Now here's where it gets interesting. Rule number 2, gross margin. Quick math, gross profit divided by revenue. You want 40% or higher. Why does this matter? Because a high gross margin means one thing, pricing power. It means customers want this specific product enough to pay a premium. They're not shopping around for the cheapest option. Think about it. Nobody says, I'll buy the knockoff Coke. They want Coca-Cola. That's pricing power, and that's exactly what Buffett looks for. Rule number 3, how the company actually runs its business. SG&A, or Selling, General, and Administrative Expenses. That's everything they spend to operate, salaries, offices, marketing, outside of actually making the product. You want SG&A at 30% or lower as a percentage of gross profit. Here's why. A company can have an amazing product with huge margins, but if management is wasting money on a fancy head office and terrible ad campaigns, those profits vanish. Buffett loves a lean, disciplined business. This number tells you if management has their act together. This next one might surprise you. Rule 4, research and development should be 30% or lower of gross profit. Now hold on, I know what you're thinking. Isn't R&D a good thing? It depends. Buffett has historically loved businesses that don't need to reinvent themselves every year. Think See's Candies. Same recipe, same customers, forever. But let's be real, his massive Apple investment proves he's not completely against R&D. This rule is a filter, not a hard line. It helps you find those stable, low-drama businesses that just print cash year after year. Rule 5, debt. Buffett is extremely cautious about borrowed money. Here's a quick test. Interest expense should be 15% or lower than operating income. A low number tells you the company funds its own growth. It's not dependent on banks. And when a recession hits, and it will, these are the companies that survive while everyone else is drowning in interest payments. Sound dramatic? It sounds aggressive because it is. High debt sinks great companies, every time. Hey, if you're finding this helpful, do me a favor. Hit that like button. Make sure you subscribe so you do not miss our future videos on building wealth through smart investing. It is totally free. It really helps the channel. Now, let's get back to the checklist. Rule 6 is simple but sneaky. Check the tax rate. You want to see a company paying a normal, consistent corporate tax rate. If it's unusually low, like way below what you'd expect, that could be a one-time accounting trick, not real sustainable earnings. Buffett cares about predictable, long-term profits. If the tax situation looks weird, the earnings probably are too. Rule 7. After every cost, every expense, every tax bill, what's actually left? Net profit margin. How much of every dollar in sales the company keeps? You want 20% or more. Now, context matters here. Very few companies actually hit 20%, and it depends heavily on the industry. Buffett owns railroads and utilities that run on much thinner margins, but the principle stands. A high, stable net margin is the mark of an exceptional business. Even if it's not 20%, you want to see it steady, not shrinking. And finally, Rule 8, earnings per share growth, EPS. This tells you how much profit the company generates for every single share you own. You want that number growing consistently over years. Why? Because growing EPS means management is doing something right. They're either growing the business profitably or they're buying back shares, which makes your shares more valuable. Either way, your ownership becomes worth more every single year. That's exactly what you want as a long-term investor. So there you have it, an 8-point checklist inspired by Buffett's principles to start finding high-quality stocks. Consistent revenue growth, gross margin over 40%, SG&A should be 30% or lower, R&D should be 30% or lower, interest expense 15% or lower than the operating income, normal tax rate, net profit margin over 20%, consistent EPS growth. Now, this checklist is a starting point, a filter. It helps you quickly spot high-quality companies worth a deeper look. The real work? Analyzing their history, comparing them to competitors, and confirming they have the moat, the trustworthy management, and the fair price that Buffett actually demands. Here's my challenge to you. Go down to the comments right now and pick one stock you own or one you're curious about. Run it through just the first rule. Check its 5-year revenue trend. Is it stable? Growing? Drop what you find in the comments.